Welcome to Inside India. I'm JP Ong, and here are your headlines. India's markets gearing up for a big rally after the government slashed taxes on hundreds of consumer items, simplifying its onerous GST structure to 2 rates. We'll discuss how far it'll go in boosting the Indian economy. Autos and life insurers among the big beneficiaries from the GST overhaul. We'll have all the reactions as we count down to the Indian market open. President Trump also indicating for the first time that his string of trade deals may have to be unwound if he loses a Supreme Court appeal to keep them in place, warning it would cause great suffering to the United States. Good morning, and a quick look now at how Asian markets are trading this Thursday morning, and we're seeing just a little bit more of signs of smiles, that is, or green shoots actually across some of these major equity indices. Take a look at the Nikkei 225, now up by about 1.2%, with the ASX 200 in Australia also trading about 0.8% higher. There are some speculations or renewed hopes of possible rate cuts from the United States, the Federal Reserve, that might be boosting equities and the outlook for stocks across this region. In contrast, though, we're seeing a little bit of pressure, actually, or downside pressure for mainland Chinese markets, with the Shanghai Composite down by about 1.6% today. Out in Hong Kong, we're seeing the Hang Seng also facing similar pressures, also falling by about 1% so far in today's session. So you're seeing some of that optimism is not being spread out, and a lot more skepticism, it seems, for traders out in Shanghai and in Hong Kong. And the Indian markets we mentioned will be coming online in just about 45 minutes. And of course, a lot of positivity, perhaps, or a lot of high expectations after the announcement of those GST modifications, actually. And we'll take a look at how Gift Nifty futures are trading. You can see it for yourself now on the board. It's trading about 250 points higher than Wednesday's close, again, indicating some interesting upside, actually, for stocks across major sectors that might benefit, including that of life insurers and auto stocks out in Mumbai. The Indian rupee, though, weakening once again to about 88.11 against the US dollar. Mind you that the all-time weakest level for the rupee, which came in just about a few weeks ago, was about 88.14. So again, we're just a little bit off of that level. Again, that divergence once again with the softer rupee actually, or softer FX actually coming despite the fact that there is renewed optimism, it seems, for stocks so far in today's session. Gift Nifty futures, as we mentioned, trading about 250 points higher than yesterday's close. And we're also watching developments on U.S. tariffs today. The Trump administration lodging its appeal to the Supreme Court to keep reciprocal tariffs on trade partners in place after a federal appeals court ruled the president overstepped his authority. The administration is seeking an expedited ruling to keep duties in place beyond mid-October. Trump indicating for the first time that trade deals he struck with the likes of EU and Japan could be unwound if the Supreme Court upholds the ruling, warning that the U.S. could, quote, suffer greatly. Meantime, the Modi government in India has now cleared historic tax reforms, slashing goods and services tax rates on several items and simplifying the entire tax structure. For more on what this means for businesses and consumers, we're going to bring in CNBC TV 18's Hormuz Fatakia, who joins us from Mumbai today. Hormuz, it's a big day and a huge announcement, a lot of sweeping reforms. Break down for us some of the major issues or some of the major things that were accomplished by these reforms that were discussed by the panel.
Big day indeed, and some big bang announcements made last night by the GST Council of India in line with the Prime Minister's address from Independence Day. Of course, there was an all-consensus decision that was taken to now have a 2-slab GST structure, which will have a 5% rate and a 5% rate and an 18% rate, while the 12% and the 28% tax slabs will be done away with, and sin goods and luxury items will now attract a special 40% structure on the GST. But before I get into a deep dive on what gets cheaper and what not, let's also first listen in to what India's Finance Minister Nirmala Sitharaman said last night after the Council's meeting ended.
This reform is not just on rationalizing rates. It's also on structural reforms. It's also on ease of living, so that businesses can do their business of working together with the GST. Reduction from 28 to 18%. इसमें मिडिल क्लास के एस्पिरेशंस मीट करने वाले बहुत सारी चीज़ हैं. एयर कंडीशंस, air conditioning machines, TVs which are over 32 inches, all TVs now at 18%. I want to underline, all TVs are now at 18%, dishwashing machines, small cars, motorcycles equal to or less than 350 cc are all now coming to 18.
You just heard the finance minister. You just heard the finance minister there as to what has the decisions been taken for the middle class to boost consumption, and that shows in the rate structure as well. Now take a look at this. The items of daily essentials like hair oils, toothpaste, soaps, they go down to a 5% rate. Items like butter, ghee, the daily spread, the consumption items of daily use, the savory snacks, all of them go down to a 5% structure. Tractor and tire parts, they go to a 5% structure. On the automotive sector, the hybrid LPG and CNG cars not exceeding 1200 cc, they go down to an 18% rate from the earlier 28%. The motorcycles of 350 cc and lower, they go down to an 18% rate. Consumer durable items like air conditioners and television, as you just heard the finance minister say, that goes down to an 18% from the existing 28%. Cement goes down to 18%. Items of stationery, which earlier was part of the 12% slab, that will have no GST on all of these items. And footwear less than $30, that goes down to 5%, while above $30, that GST rate remains the same. Now, what about insurance companies? Of course, based on what analysts tell us, the insurance premiums being exempted from GST, that makes it costlier for the companies, but makes it cheaper for policyholders, and no significant impact on coal and on sectors like carbonated beverages.
So, Hormuz, pretty much good for the Indian consumer unless you're someone who's driving an SUV while smoking a cigarette and sipping a Coca-Cola. Otherwise, good if you're trying to go out there and actually buy more things. So it's good for the Indian consumer, but perhaps also meaning fewer tax revenues actually for the government. What did the government have to say about possible revenue shortfalls due to this overhaul?
The government did mention about this last night, that the compensation cess was discussed, and a lot of the state finance ministers who we spoke to, they mentioned that the loss from this two-rate structure is now pegged at almost $10 billion, but because of this 40% rate on sin goods and luxury items, that will bring in a revenue of around $5 billion. So the net revenue loss estimated is somewhere around $5 to $5.5 billion. Of course, this is basis the FY24 consumption trends, is what the Revenue Secretary explained last night during the press conference. Now they are expecting the compliance to improve because of this reduction in GST rates, and as compliance improves, and that will result in some buoyancy in tax revenues. They are also expecting this to remain financially sustainable. And of course, they also mentioned about the compensation cess, which will continue on specific goods like tobacco and tobacco products, and once the state payouts are discharged, then this compensation cess will be done away with. And once this compensation cess is done away with, the items that currently continue to attract a cess of this, like tobacco and tobacco products, all of them will now have a GST rate of 40% once the rationalization takes place. So overall, a positive move for the Indian consumer and a boost to the consumption as well. Of course, mind you, all of these consumption stocks have moved pretty significantly in light of the Prime Minister's address, so we need to keep an eye out on all of these names in today's session.
And that's going to be the next challenge, perhaps, Hormuz, how the government's going to be able to balance giving back all of this to the consumer while making sure that the fiscal balances are maintained. Hormuz Fatakia from CNBC TV 18, thank you so much for that comprehensive breakdown, at least, of what the GST reforms might mean. And we'll get more of a breakdown or an analysis of this, actually, from Maulik Manikoalia, who is a partner of indirect tax at BDO India. And he joins us now on the line to talk about this momentous shift so far. Maulik, thank you so much for joining us today. Let's start off with the impact actually on the consumer, because again, this was really meant to try and empower the Indian consumer, which is one of the biggest drivers of Asia's third largest economy. Where is the boost going to be seen most actually with regards to consumers, and where do you expect this to actually show up the most as upside?
Yeah, hi, good morning, and thanks for having me on the show. So, what we also saw yesterday, that this is a mega reform when it comes to GST. So it was very well awaited, and government was working on this reclassification since a long time. So with respect to the consumption, I think there will be a lot of more power to the consumers with respect to the income that they can actually spend on other products. And when we talk about sectors, the sectors are particularly with respect to where we generally see are like FMCG, FMCD, like fast-moving consumer durables, automobiles. Automobiles are also something wherein a significant reduction has been done. Farmer and agriculture is something that government has also focused on. So with respect to the consumption boost, a lot of disposable income will be there with people. And when it comes to aspirational buying, I'm sure a lot of people will be shifting to those products as well. Particularly with respect to the common man, government has focused a lot with respect to that. And when it comes to this tax slabs, majority of the products which were earlier into 12% have been shifted to say 5%. And for classification as well, what they have done is they've kept it like three rate structure, like 5%, 18%, and 40%. So a lot of products have been reduced to 5% for the daily essential needs, and it's definitely going to boost in consumption.
Malik, a lot of this actually was seen as an introduction to try and buffer, shield the Indian economy from the impact of the U.S. tariffs on various sectors like textiles and the like. And no surprise that textiles, for instance, got a huge amount of support from these GST restructurings or realignments. I have a question. Do you think that this can actually offset any negative impacts for sectors like textiles, for instance, the lower taxes for perhaps boosting consumption that might offset any export losses?
So that's definitely going to happen. Like, say, for example, right now, any which ways, there are a lot of impact with respect to the global tariffs and all. So all the sectors which are facing trouble because of sudden slowdown in exports are definitely going to see a huge consumption in the local economy. And since people will be having more purchasing power, it's definitely going to help in boosting these sectors. Like you rightly pointed out, textiles was one of the largest sector which was getting impacted because of all these tariffs and all. So there are quite a few other sectors as well which are going to get the benefit from this reductions, or rather rate rationalization.
Malik, again, while this is good for the consumer, this is something we brought up actually with Hormaz a while ago. It also means that it could actually impact the ability of India to collect tax revenues. Can the consumption boost offset the tax shortfalls? Basically, net-net, is this going to be good for the Indian economy and even tax revenues that could rise if there is more activity? But again, because the rate is lower, it means that there is some pressure on the tax collection side for the Indian government.
Yeah, so honestly speaking, it's like pretty much a temporary shortfall in the taxes, really, which one can anticipate. And when it comes to the shortfalls as well, those shortfalls are estimated based on 2023-24 numbers. And today, as on date, the consumption is way higher than those numbers in that financial year. So as such, when we talk about, say, a shortfall of $10 billion as against a net shortfall of $5 billion after adjusting the seen goods tax, eventually the consumption is going to increase way higher. So going forward, I'm sure there is not going to be a significant shortfall in the taxes, because if we see from a GST perspective, when GST was launched, at that point of time, there were close to 6 million taxpayers base, and now it is like close to 15 million taxpayer base. So all government wants us to bring in a large taxpayer into this particular ambit of GST. And that's why really when it comes to the consumption, I'm sure with more and more consumption, these things are going to be set off in a couple of months. It's not going to stay longer as a shortfall.
The other concern that we have also, Malik, is that we've seen a number of local governments starting to voice a little bit of disgruntlement, actually, with regards to the lower taxes that could go to their own local governments. And perhaps even there is a concern that maybe they might even try to look for other taxes to raise to make up for the shortfalls in their budgets. If that does happen, could we see any possible benefits to the consumers negated if they start to see taxes in other places rise, and thus also offset any possible consumption boost? Do you think this is a risk?
So technically speaking, when it comes to GST rate rationalization, is both for the center as well as states. And right now, any two states are getting their contributions from center as well as their own local taxes. But for now, there are no new taxes which are there on the cards, or really they're going to increase. So there might increase something or at a very local level, at state level. but there's nothing that they can do with respect to the GST, because this is something driven through center as well as GST Council. And it would be really difficult for them to increase those rates. And as against the compensation, honestly speaking, the boost in consumption is definitely going to get a lot of more revenue for all the states as well.
Malik, the other thing that some people are pointing out that might actually be more important than the lowering of the GST rates actually is the simplification of it. We've gone from 4 slabs to 2, and also just an easier, more streamlined ways of figuring out how much businesses will owe in terms of goods and services taxes. What kind of impact will this have in terms of possibly boosting the economic prospects of India, or even helping them with their tax collections?
So see, to be very honest, it's like when government had initially came up with white paper of GST, there was always a plan that was there put on the paper that going forward it's going to be very simplified structure. At that point of time, just to offset all sort of effects of those legacy taxes, there were multiple rates and structures that government had proposed. But this was pretty much on the cards with respect to the simplified tax structure and having pretty much standardized rates of 18%. And when it comes to average rate, right now it's 15%, but going forward, we anticipate it will go way lower when it comes to average tax rate. It can also go sub 10%, but that is again something that we'll have to rely on the statistics where we get in future. But yeah, definitely this is going to help in simplifying a lot of business processes. A lot of benefit is going to happen to MSMEs as well. And like I mentioned, that the government wants to increase their taxpayer base. And once the taxpayer base is increased, a lot of more and more taxpayers will come into the system, and that will definitely help in increasing the consumption as well as the taxes for the government.
Malik, I'm glad you brought up MSMEs, because a lot of this, again, is meant to simplify things for India, but it still doesn't perhaps erase the possible macro headwinds, such as, say, cheaper imports from China, which is another concern for Indian businesses. Can the GST rationalization and the possible boost to consumption actually offset the threat of these cheaper Chinese imports that might be coming in and might pose threats that will be felt more by the MSMEs in India that are hoping for this boost?
So with respect to the cheaper imports, I think government is taking all the measures with respect to anti-dumping duties and all. And for that perspective, when it comes to MSMEs, they are definitely going to get more opportunities with respect to doing business in India. Furthermore, they also simplified a couple of processes with respect to the refunds, with respect to registrations and all. So when it comes to overall MSME base, definitely there are going to be some simplified reforms that they will get. Furthermore, to offset what all cheaper imports are happening, government is definitely focusing on boosting Make in India initiatives. So, to be very honest, it's like the products like defense and all the sectors have seen significant rate reductions. It has moved to 0%. So the focus is on absolutely making in India, and definitely, I'm sure government will take corrective measures in future as well with respect to those anti-dumping duties and all those things as well.
Malik, a lot of these reforms come at a very apt time, actually, because it comes right before the festive season in India. Help us understand what this will mean actually for the festive season and what kind of impact it might have to sales during this period.
So one of the major concerns for industry at large before this council meeting was that when it's going to be implemented, and that's what really like what GST Council decided yesterday, that it's going to be implemented on 22nd of September, that is first day of Navratri in India. And a lot of consumption is going to happen in that particular last week of September in India. A lot of buying would be happening across sectors like FMCG, FMCD, and automobile, textile, footwear. A lot of sectors are going to see consumption at that point of time. And like rightly pointed out, that it's going to be before the festivities of Diwali, and also a lot of buying is any which way is anticipated in this month. And this is definitely going to add a lot of triggers with respect to sales across the sectors.
So it seems that the timing of these GSTs also were meant to coincide with the festive season so that it has the most impact or perhaps most bang for their buck. And we'll see if that does indeed happen at the end of this month and throughout most of October. Maulik Manikwala from BDO India, thank you so much for joining us today and helping our viewers understand exactly what the implications and the benefits are from this potential rationalization of the GST rates in India. Well, coming up, we will talk more about the legal trouble for President Trump's tariffs and India's increasing diplomatic engagements. Well, as we mentioned earlier, U.S. President Donald Trump has appealed to the Supreme Court against a federal court ruling that challenged his administration's reciprocal tariffs. We'll be back in just a little bit. Welcome back. As we mentioned earlier, U.S. President Donald Trump has appealed to the Supreme Court against a federal court ruling that challenged his administration's reciprocal tariffs on trade partners. CNBC's Megan Casella takes a closer look at what would happen if that ruling holds.
The vast majority of the tariffs the president has imposed so far this term would fall away if he loses this case before the Supreme Court. And that would mean a big drop in revenue, just over $500 million expected over the next decade if the court ruling holds, according to the Tax Foundation, versus about $2.3 trillion estimated now. But the White House has vowed to find other ways to impose tariffs, and they're working on a handful of options President Trump can pursue without Congress. The first and probably the most likely is called Section 338. It's part of the Smoot-Hawley Act passed back in 1930. White House officials have talked openly about using it, and while it wasn't the initial justification for the president's tariffs, Trump allies at the America First Policy Institute are now arguing before the court that an executive order can be upheld under a statute not originally cited. They say that Section 338 fits the challenged tariffs like a glove. Now, the next best option is Section 232 of trade law. This allows tariffs on individual sectors for national security reasons. 9 of these investigations are currently ongoing, which could mean tariffs on a staggering amount of trade, from furniture to smartphones, solar panels, and windmills. And there are other options, too. Section 301 is what the president used in the first term against China. Another statute, 122, allows tariffs on a temporary basis to correct for trade deficits. So all of this means that no matter what happens in the court system, President Trump does not have to turn to Congress. He will all but certainly be finding ways to forge ahead with tariffs by himself. Megan Casella, CNBC Business News, Washington.
Meantime, despite the looming legal threat over President Trump's tariffs, India is increasing trade negotiations with other countries as it faces 50% tariffs from the United States. German Foreign Minister Johann Wadephul was in New Delhi welcoming India's push to double bilateral trade, which is now at 31 billion euros. Wadephul also added that lowering tariffs is the best response to global trade barriers. Here's what the two sides had to say on India's trade talks with the European Union.
We count on your support to deepen our relationship with the European Union and expedite the FTA negotiations. India and Germany have a strong history of multilateral cooperation, which I'm confident will be further advanced through our talks today.
Economically, you already mentioned the FTA. Germany is a full supporter of getting this agreement negotiated as soon as even possible. We are a free trade nation.
Also, Singapore's Prime Minister Lawrence Wong is in New Delhi on his first state visit to India. The trip marks 60 years of diplomatic relations between the two countries. Wong will meet Prime Minister Modi, President Murmu, and join a roundtable with Indian business heads. The visit highlights Singapore's push to deepen economic ties with India, and New Delhi is looking at the country as a key bridge with the wider ASEAN region. A quick check now on how Asian markets are faring, and 25 minutes past the 11 hour, we are seeing that markets are holding on to some gains. And again, that dichotomy or that divergence continues to hold with strong gains from markets like the Nikkei 225 up by 1.2%, but still sluggishness for Shanghai and the Hang Seng in today's session. Overall, markets in Southeast Asia also doing fairly well, though the Bursa in Malaysia is just flat to the upside. And coming up, India's bond market catching the eye of local investors. A deeper dive coming right after this short break. Stay tuned. We are counting down to the market open in India in less than 15 minutes, and we want to take a look again at what futures are foreshadowing today. And again, as expected, a pretty decent bump up, it seems, from yesterday's close. Nifty futures, gift Nifty futures, that is, trading more than 200 points above the Wednesday close. The rupee, though, still looking a bit soft as it has in recent days at about 88.07 against the U.S. dollar. But again, a lot of this positivity and a lot of this optimism perhaps being driven by the announced GST rationalization or the GST reforms that might boost consumer spending and overall the Indian economy as well. Nifty futures, we mentioned, about 200 points above the close from Wednesday. A private gauge shows India's services sector surged to a 15-year high in August, driven by robust demand and strong export orders. The HSBC PMI jumped to nearly 63, signaling rapid growth, but also noted price pressures with output costs rising at the fastest pace in over a decade. The data comes after India's economy grew nearly 8% last quarter. But analysts warned that the 50% U.S. tariffs could soon weigh on exports. Quick check on where the Indian government bond yields are sitting right now. And again, we'll have to wait until 11:45 to see exactly how they're moving. But you can see where they're sitting at the moment with the 10-year bond yield, about 6.5% so far in today's session. Slight steepening, it seems, from across the yield curve, actually, with longer-term tenors just easing just a little bit in sharp contrast to some of these more developed market bonds, actually. But again, no, we are seeing again that bond yields continue to deal from a significant uptick, actually, over the month of August on questions about fiscal revenues in India and perhaps also growth concerns that might be assuaged in part by some of those GST reforms that could boost consumption. Foreign investors are also piling back, it seems. Net purchases topped about $1.2 billion in August. That's the biggest inflow in about 5 months. Higher yields and expectations of rate cuts are driving demand, with investors also seeing the GST meet some market participants' expectations, who believe that the tax cuts could add to the government's fiscal burden, leading to more borrowing. So a lot of things to really balance, it seems, for folks in India as they try to at least manage the impact of these GST reforms that could benefit the consumer, but also pose new challenges for balancing the fiscal levels, actually, in India. Broadening out to the U.S., Treasury yields looking like this. Also, the 30-year yield briefly hitting 5% once again before pulling back. Currently at about the 30 yield at 4.905%. We're also seeing the 10-year tenor, at least in the U.S., also about 4.22% in today's session. All eyes are on the Federal Reserve, with a decision just 2 weeks away. Policymakers are closely watching jobs data and weighing the impact of new tariffs on inflation. Our U.S. team caught up with Fed Governor Christopher Waller for insight into what could shape the Federal Reserve's next move.
We want to get ahead of having the labor market go down, because usually when the labor market turns bad, it turns bad fast in a non-linear fashion. It doesn't just kind of creep up. So for me, I think we need to start cutting rates at the next meeting, and then we don't have to go in a locked sequence of steps. We can kind of see where things are going, because people are still worried about tariff inflation. I'm not, but everybody else is. So I would say over the next 3 to 6 months, we could see multiple cuts coming in. Whether it's like every meeting, we'll have to wait and see what the data says.
And where are we headed, in your opinion? Do you have a view of neutral, of where you'd like to get to, or do you need to even be below neutral?
Well, like I said, I usually use the SEP benchmark.
That's the Summary of Economic Projections.
Summary of Economic
That's
Projections.
The average of all the Fed officials and their long-run rate.
Right. So that gives me kind of a benchmark where the middle of the committee seems to be, and I use that to think about where neutral is. Could be higher, could be lower. You have people all over the map on this. So, but if you take 3%, you're about 125, 150 basis points above that. And if tariff inflation looks like it's going to be temporary and it's a one-time level effect, which I think, inflation expectations are anchored, and the labor market's really weakening. So our dual mandate says worry about employment and inflation, look through the inflation, worry about the employment, start cutting.
And what might this mean for bond markets in Asia, specifically that of India as well? Nathan Sribalasundaram is an Asia rate strategist at Nomura, and he's here to answer exactly that question and then some. Nathan, thank you so much for joining us today. Let's start off with the recent moves in the bond market, especially the last couple of days. It's really caught a lot of traders across different asset classes by surprise. The rising yields, actually, for your long-term tenors out in the U.S. and developed markets. What does this mean, actually, for places like India and emerging markets in this part of the world?
Yeah, it's certainly caught a lot of people off guard, I suspect, and it's not just succinct to the US. We're seeing it across, Europe and across Japan, and gilts as well have seen a significant rise in the long end. I think a lot has been driven by some fiscal risks, and that's playing through into these emerging markets. For emerging markets, we think that a lot of the fiscal risks are a lot less serious than some of these more developed countries. We're not seeing that supply pressure in the bond markets come through in emerging markets. So we do think that emerging markets are better placed and should see some inflows. But I guess we do need to be a little bit cognizant of the risk sentiment globally towards emerging markets and also the dollar.
Right. And one thing that we also noticed over the last couple of days, and again, this is just based on my cursory novice reading of bond yields, we also noticed some of the longer end yields of tenors, at least on the Indian yield curve, were all actually easing, not by much, but a little bit. But it also points at a bit of a divergence. Should we make something of this particular reading, either for better or worse?
I think this consolidation comes after a few weeks of actually very negative sentiment towards India yields. So ever since to be honest, June, we've been seeing an upwards trend in India yields, and that really accelerated since the early part of August following the August MPC meeting, where we've seen India 10-year yields move close to 35, 40 basis points higher. And India long-end yields are also seeing a similar move, especially in the 30-year IGB. So I suspect that over the last couple of days, we've reached some kind of level of consolidation. Some of the news out of the GST Council seems to be, not as bad as some people had feared. And there seems to have also been some comments from Indian government officials, reaffirming their stance around the fiscal deficit for this year, which is giving some comfort to the market for now.
Right, and I did notice also that 5-year yields over the month of August actually rose by about 32 basis points. That's coming down a little bit, perhaps pointing at that uptick in yields that you were mentioning. One thing we talked about earlier on before the interview, Nathan, was the fact that we saw foreign buyers continuing to come into Indian bonds. They bought more than $1 billion, if I'm not mistaken. And it seems that foreign sentiment is a bit different from the more cynical view, for lack of a better term, that we're seeing in the onshore markets in India. Why do you think there's a divergence? Why do you think foreign investors, or foreign bond buyers at least, are a bit more upbeat about the fixed income space in India than their own investors domestically?
So I think from a foreign allocation perspective, like EM in high yield and in Asia, India, Indonesia fit well into that kind of the weaker dollar, search for yield kind of asset class. And that's why we're seeing inflows into India. There's also an index inclusion taking place from this month, September, which is happening for India bonds, another positive. But it's worth noting that, the ownership of India bonds by foreign investors is still relatively low at 3.5%. And so most of the price action is still being driven by onshore. And onshore sentiment is for us very negative. I think we've also been reaching a point where the market is, erring on the side of becoming a little bit dysfunctional in the Indian bond market. We've seen a couple of issuers have to cancel issuances at both the SOE and the corporate level over the past couple of weeks, citing the higher yields as a negative. And also some of the state bond auctions that have been going through over the past month have been taken down very poorly, with, again, a few states not actually being able to issue bonds into the market. So the sentiment from onshore clients, we think, is very negative. And that's why we've been highlighting in a few of our reports that, it's hard to time when, but we may be reaching a point where we need to see some intervention from either the RBI themselves or from the government of India with regards to the outlook for the supply of Indian bonds.
Right. So do you think that foreign investors or foreign bond investors should take a little bit of note, actually, from the skepticism that domestic investors are seeing on the ground?
I think so. I think if you're a medium-term foreign investor, then the yields look quite attractive. And, we also think that yields look somewhat attractive. But in the short term, I think we need to see some of these measures come through from the government or the RBI to kind of really give that a sentiment a turnaround for India.
Okay. So let's talk about some of these the issues with regards to the GST. Now, it is going to be an upside for the Indian economy because of how the impact will have on its biggest driver, which is consumption. But again, it might mean lower revenue shortfalls, and some estimates put it at about $5 billion. Is that something we'll have to worry about when it comes to sovereign bonds in India because of the impact on the fiscal government? Or is this a bit of a nothing burger, Nathan?
So we think it's a little bit of a nothing, not a huge issue, to be honest. But I think quite early on, when this announcement came out on Independence Day a few weeks ago, there was a lot of kind of unknowns in terms of the actual impact on the fiscal side. So we weren't particularly, or the market was a little bit unsure in terms of the revenue hit. Overnight, we seem to have had that clarity. It is around that $5 billion US dollars in terms of the net impact for the remainder of this year. So we think that, borrowing is not going to be increased for the remainder of this fiscal year, FY26. We think that even this small slippage, the government have other means or other avenues to finance that fiscal slip, most notably the short-term debt issuance. So we're fairly confident in that. But I think more broadly, with the India-US tariffs at 50% and any kind of future, fiscal measures that need to support the sectors, especially the export sectors, from these higher tariffs, they're probably going to continue to weigh a little bit on the bond investors' minds.
Now, if those tariffs, though, are appealed at the Supreme Court, does that mean a lot of these measures to try and buffer yourself from the impact of the tariffs will come to nothing and it'll be good? Or is this going to open another can of worms for policymakers and even for the bond markets to deal with if it's unwound? Because, again, it could actually mean that the deficits in the U.S. might remain high and pose longer-term risks. How do we balance out some of these implications that moving forward?
I think near term is positive for India yields. The market will assume that some of these risks, especially around kind of currency and around fiscal, get relieved fairly quickly, and that should see a bit of outperformance of India bonds. Of course, the longer term impact of US fiscal will continue to play, and I guess this multi-year trend that we've been seeing of EM outperformance versus DM is just going to get another boost, and we'll continue to see that kind of India-US spread compress over time.
Nathan Srivalasundaram from Nomura, thank you so much for joining us today and helping us understand the implications, that is, for the bond markets out in India and the pros and cons of all of these developments. Again, I appreciate your insights, sir.
Thank you very much for having me.
Thank you. Good. And we'll keep it with bonds now. We'll bring in Lin now. We're getting some updates on the 30-year JGB auction, and very timely to bring up these things after a conversation with Nathan. Actually, Lin, tell us more.
Hey, JP, the auction happened a few minutes ago, and basically we're seeing more of what we've seen over the summer in Japan, particularly in terms of these back-end bonds, with the bid to cover ratio, which is the gauge here for demand, coming in at the lowest since the June auction there, so 3.31%. We've also seen the auction tail widen to 0.18 percentage points. So this is again showing versus the previous month weaker demand, patchier demand. So we continue to watch this space, because even though there's been a bit of a pullback in terms of yields, a bit of stabilization as we've seen in the US and other places as well overnight, that as a trend over the last few months in terms of JGBs, the direction has been upward. And there's a lot of factors at play here, of course. Certainly the Bank of Japan's policy after decades that have kept yields really anchored, right? That is, of course, changing. The Bank of Japan is tapering bond purchases. We're seeing that Japan is, of course, dealing with elevated inflation as well over a period. And then also this week in particular, the political situation has come back into focus again, with the markets interpreting some of this upheaval again as expectations that ultimately we're going to see politicians push for more fiscal stimulus. So what we've seen is that Ishiba is basically losing some of his supporters. We've got 4 top aides this week announcing that they're willing to step down, basically to take responsibility for that upper house election result. And then you have heavyweights within the party, like the former Prime Minister Taro Aso, coming out publicly to say that he is endorsing the vote for an earlier leadership contest. So we're coming to a pointy end here, and it really is going to come down to this vote that is happening next Monday, where the party members will decide whether or not they want to have an earlier leadership contest. And basically, if they vote in that majority, it is a clear signal for the Prime Minister to depart. part here. And, you know, the view is that the LDP, which has been in control for many decades, is hugely unpopular. And therefore, you know, even with a new prime minister, that we could be seeing more of that fiscal stimulus and therefore more issuance. JP.
But overall, lower and lamer appetites, it seems, for these bond yields, reflecting the uncertainty out in Japan. Lynn, fascinating, and thank you so much for bringing us an update on how this is influencing trends, at least in the Japanese bond markets. And also, we're still counting down to the market open in Mumbai. Actually, it's open now, but we'll be taking a look at how these markets are now reacting to the GST overhaul. Stay tuned. You're in Inside India. Well, the markets have been trading now for about 2.5 minutes. Not expected. Green is a go for the Nifty 50. They are trading about 0.6% in the green now. 24,870 points is where the benchmark is sitting at the moment. Even the rupee is getting a little bit of room to flex after days of weakness and softness. We're seeing just a little bit of a firmer session for the Indian currency at 88.02 against the US dollar. We take a quick look now at how auto stocks listed in Mumbai are opening today. It's one of those sectors that was expected to get good upside actually from the GST reforms. Take a look at that across the board. Maruti Suzuki, Mahindra & Mahindra popping with a near 6% gain so far in today's session. They're wearing the biggest smile out of the car makers and car stocks out in India. Hyundai Motor also trading about 1% higher. Tata holding on to gains of about 1.9%. According to the latest GST reforms, taxes on smaller cars and motorcycles up to 350cc will be reduced to 18% from the current 28%. Luxury cars, though, will continue to see higher taxes at about 40%. And also in the insurance sector as well, getting a big boost as the GST panel decided to cut the taxes on life and insurance to 0 from 18%. Again, no surprise to see most of them actually surging today. Niva Bupa actually up by almost 5% in today's session. You've also got the new India Assurance stock actually also up by about 3.1%. Star Health holding on to that 3.9% jump in today's session. With the Nifty Fast Mover Consumer Goods Index also looking quite good. Take a look at that, 1.5% also on the back of expected upside in terms of consumer spending, especially leading up to that festive season that might give the impact of these GST reforms more bang for their buck. And again, that bang is indeed showing up in the FMCG index up by about 1.5%. We also want to talk about alternative investments in India, so in today's session also, Vishal Tulsian is the CEO and Managing Director at Motilal Oswal Alternates, joining us from the 21st Motilal Oswal Annual Global Investor Conference. On this momentous day, it seems, and a significant day for Indian markets. Vishal, thank you so much for joining us in today's session. This aside, though, I do want to ask you about the opening of the closing of the India Business Excellence Fund 5, which you guys just recently launched. Now, I know you just closed it about a week and a half ago to the tune of about $800 million, but can you give us an idea of how it's going and where, if the fund's gone anywhere interesting since it opened just recently?
So hi, good morning to you and all your viewers. I think we've got an excellent response when we launched this fund in May of 2025. Our target was to raise $950 million, but we never expected that we'll have first close in less than 3 months at over 80% of our targeted fund size. And we are hoping to do the final close of the fund in a few months from now at our target size of $950 million. This just shows the amount of confidence that people have shown in us. We started this venture 20 years ago, and this is our 5th private equity fund. Never ever we have seen a response of this kind in such a short time frame.
Alternative investments in private equity in India, this is an area that we don't talk about as much, I believe. What are the gaps in financing that the fund and the private equity and alternatives operations of Motilal Oswal want to target or meet? What do you think are some of the gaps that you're hoping to address and perhaps find opportunities in, sir?
We have our distinct investment philosophy, as you are aware, which is called QGLP, where Q stands for quality of business and entrepreneur, G stands for growth, L for longevity of the growth, and P for buying it at a reasonable price. This is something that we've been practicing for a long period of time. I think what is extremely important is to identify companies that can have a longevity as far as the growth is concerned. And for that, it is extremely important to back first generation, highly competent entrepreneurs and businesses that have tailwind. We typically look to invest in 4 different sectors: consumer, financial services, pharma, and manufacturing. And as I said, we like to invest in first generation entrepreneurs. That is where we feel the need of the capital is the maximum, and is something that we look to bridge.
Vishal, you do focus a lot on medium-sized firms and those that actually need your support most. And it has been identified some of the headwinds facing the Indian economy, whether it be Trump tariffs or perhaps competitive Chinese imports, might impact these MSMEs more gravely than some of their larger counterparts. How do these 2 particular headwinds perhaps shape the investment decisions for Motilal, given the high uncertainty it can pose to some of the clients that you are targeting right now?
So actually, if you ask me, a lot of our investment is actually driven by, the domestic consumption theme. The per capita income in India has grown at 9% in dollar terms over the last 25 years. We are still at sub $3,000 per capita. A lot of room is still there for India to grow, continue to grow at this rate over a long period of time. So actually, to give you a sense, our portfolio company in the last financial year actually grew at 40% in terms of their revenue and 35% plus in terms of their EBITDA. And we continue to see the same growth momentum in first quarter as well. As I said, there's enough ample room in India as far as growth is concerned. You have to pick the right set of entrepreneurs that you want to back, who are highly competent and have tremendous amount of fire in the belly to grow over a long period of time. A lot of our investments are also driven by, in the manufacturing space, where we like to invest in businesses which can actually replace a lot of imports, something that can be manufactured in India as well. In 2008, we had actually invested in a company called Dixon Technologies, at a value of less than $25 million. The company is worth, over $11-12 billion as we speak. And that is largely driven by the fact that Indian government is conscious of the fact that we have to start manufacturing in India for India and in India for world at large.
So So it's undoubted, Vishal, that the consumption story in India remains intact, and especially with the GST rationalization, this might get a further boost. But I do want to talk about one area in India that has always had me scratching my head, and that's tech, the tech sector. Because when you look at India, it seems to have all the ingredients to actually become a major tech player in the world, and even in these new technologies like AI. But some say that that the private equity and VC funding space in India might be a bit too conservative, which is why we're seeing fewer startups and forays in these new technologies, despite all the potential resources that India can devote to this, whether it be natural or human capital-wise. Do you think it's fair to characterize the VC and private equity space as being a bit too conservative in the tech space in India, sir? Share with us your thoughts.
You know, historically, if you really look at the India private equity and VC story way back in late 90s and early 2000, started with tech investments. And the initial, experience for many of the funds from those investments have not been great. But over the last 20 years, you have seen a lot of global firms doing buyouts in the tech space, and that has worked out very well for most of them. As a firm, we've not yet started investing in that space as such. But it is something which is also going to be an area of interest for us as we move ahead.
Vishal, when you talked about looking for entrepreneurs with a fire in your belly, it seems like you're hinting at the intangibles, actually. And this is something important when you're looking at the private equity or venture capital space. Can you talk to us about more of what other intangibles you look out for beyond the balance sheets when you're looking to invest?
So actually, we have over our, given that we've been investing for such a long period of time, we typically look at, as I said, first generation entrepreneurs, who have high degree of integrity, and more than that, competency to build a firm which can outlast them, which can continue to grow for a long period of time. And for that, as I said, you need to back people who are passionate, people who are conscious of the fact that they need to build an institution which can outlive the entrepreneur himself, and most importantly, try to look at backing entrepreneurs which have a lot of grace.
Vishal, thank you so much for joining us. That's all the time we have, but we appreciate the time. Vishal from Motilal Oswal. That's it for Inside India. We'll see you tomorrow.